Hi guys. So I just made a great chart. Gold price, inflation adjusted, and I think I'm very proud of it because this is the kind of work that is very very hard to find. Actually, I haven't found that, and the problem is that if you have work like this, they always have the inflation numbers absolutely wrong. If you look back at the history of the gold price or any prices, and you adjust it for inflation, because of course you can't like look back at prices of 50 years ago or so and say like, okay, today it's more expensive than then because 50 years ago the value of the dollar was much higher. So you have to look you have to discount inflation to see like, okay, what was the real price at the time, and then you have to look at what was the real value of the dollar at the time compared to today. And that almost everybody has wrong because the inflation is I have it correct as one of the very few analysts. The inflation is on average 6% since 1928, and that is already deducting 2% for economic growth. So the balance sheet of the Federal Reserve is growing by 8% per year on average since 1928. Actually, the past 30 years it was 9%. The past 10 years it's 10%. Um, but sometimes it's a lot higher. The past 10 years can be 20%, but it can also be the past 10 years, it can also be negative, minus 2%. Um, but this is what causes inflation. It's money printing. And you can see how much money they print, they publish that. And it's basically their balance sheet. The amount of assets that they have on the balance sheet is the amount of money they print, because they don't buy those assets by working for it and earning money for it. No, they buy those assets by printing money and buying it. And so the more assets they have, the more money there is in circulation. And then what they also sometimes do is sell off some of those assets, and then they also destroy that money. It's not like when they sell the asset and they get, let's say, $1 million for an asset, that they then keep that million in cash. No, they also delete it from the balance sheet. And so they create money, but they also destroy money. Um, and so, but of course, that's what caused inflation. It's not rocket science. Minus economic growth, because if you say have like 2% economic growth per year, then if you print no money, then the value of your money goes up with 2%. If that's the only money in the economy, which is pretty much the case still for the US dollar in the US, is the only money available. So if the amount of product service goes up with 2%, but the amount of money not, then the value of the money goes. You can buy 2% more products and services with the same amount of money. But of course, that's not happening on average. The amount of money in circulation goes up by 8%, while while the economy grows on average by 2%. So on average, you have a 6% inflation, meaning the prices on average of products, services, but also assets, and also utilities, and also insurance, and like, you have to look at all prices, and then you can indeed see that indeed the average is 6%, because you cannot just look at milk, for example. Milk is a commodity. It goes down in price over time. So with milk, you will see that the actual price increases is not 6%, it's maybe 4% or 3%. And that's what then people use to justify a low inflation rate of 2% or 3 or so. But that's not the only good that we're buying in the economy. Land, for example, is also a valuable good, or gold, or stock indexes. And you can see here that stock index actually go up by 9%. So then you could say, but then there is actually 9% inflation. But that's also not true, because actually an index fund, for example, um, yeah, does create wealth, but it's not as much as people think. It's not 9%, because you have to deduct 6%, so it's actually only 3% per year. But gold, for example, people say that's an inflation hedge. It's not, because it is, but not that great of an inflation hedge as stock indexes, for example, because only has 5% on average. But I'm interested to short gold, and I'm looking at is gold a great short now or not? My thesis is that we are in a long-term bear market for gold and bull market for stocks. Um, uh, Considering a cycle, bear year 1940, 50, 60s, bear for gold, bull for gold, 1970s, 1980s, 90s, bear for gold, 2000 till 2010, bull for gold, 2010 till 2020, bear for gold, but we haven't reached the lows yet, and also the duration is too short. In 10 years, it's very unlikely that the bear market of gold is finished, because that hasn't happened in the past, at least not the past 100 years. It has been minimum 20 years and sometimes even 30 years of bear market. So 10 years is extremely short. Another indicator is also, I published that video before, you want to look at production. Before every bull market in gold, you see a decline in production. That's what you really want to see, because that's the hard evidence that gold is too cheap. When prices are so cheap that gold producers are shutting down mines, that means it's really cheap. And that's strong evidence that this is unsustainable, because we do need more gold over time. The population is growing by 2% per year, and people also like use more and more gold over time. And not as in the form of money, but in the form of uh, jewelry. Demand goes up over time. So, but sometimes prices are too low to continue to have see production increase. So last I checked, this was also not the case. Production has been going up rapidly since up until 2020. There was one year I made a video about that. Indeed, last year, 2019, it also went up, but there were some, like, it was basically sideways. And but okay, it was or this year also, like, but this was mainly because of the COVID corona crisis, and governments forcefully shutting down production, of course. But that's not like you want to see production shut down because the gold price is too low, and that's not been the case yet. So this is all a strong indicator that we're not ready for a long-term bull market, because once gold production goes down, then you can say that, okay, this cannot hold. Sooner or later, the price of gold has to go up, because it cannot continue to go down. Gold production, that's not realistic, because demand for gold goes up over time. So the moment production starts to decline, you know that the prices are too cheap, and sooner or later they will go up a lot. But as long as that is not happening, as long as production is going up rapidly, then you know that gold prices are high enough to see the mining production continue to go up, and so there will not be a shortage, and that's where we are right now. So that's why I'm very bearish on gold, because the long-term cycle shows that we're not ready. Like 10 years is not enough to get rid of the excess supply from the previous bull market. That's very unlikely, but also uh, production has not been declining yet. So for me, I'm very convinced that I think the probability is very high, like 90% certainty, that we have a long-term bear market for another 10 years in gold, and a long-term bull market for stocks, because they are inversely correlated, as you can see here. Um, when gold is bad, stocks are in a bull market. When gold goes in a bull market, stocks goes in a bear market. It's only logical, because gold is linked to commodities. When commodities become expensive, usually these are gold and commodities are in the same cycle. Another strong indicator that this is not a sustainable gold bull market, because today commodities are very cheap. It's only gold that's going up a lot, not commodities in general. This is a strong indicator also that we are not ready for a commodity bull market. There is no shortage in commodity. There is a temporary shortage in gold due to the corona crisis and the fear levels in the market. But that will fly over, because the corona crisis is also artificially created. It's a political crisis, it's not a real pandemic. It's not a real. People are not dying en masse. The hospitals are not full. So this is flying over at rapid speed. People start to realize they've been fooled, and move on with their lives. And so they will revert. The fear levels will go down, and the gold will be sold for stocks. It's very likely to happen. But what I also did was making a chart here to study, like, what's the price level of today, like what is gold overvalued or undervalued. And I made it here, and I think yeah, I did an amazing job. We're at $2,000 today, and if you make the chart adjusted for real inflation, um, what is the gold price of the past, huh? And for example, the bubble in 2010, we went to 1,800, but if you adjust that for inflation, 2011, the peak was 1,600 or so, but if you adjust that for inflation, it's around 3,000 dollars. So now we're at 2,000, but 10 years ago we were at 3,000. That was the peak. Then the bottom was in 2000 at $1,000 inflation adjusted. Of course, the real price in 2000 was $300, huh? But inflation adjusted, that was $3,000. Huh? And then we had the big bubble of 1980, the peak there. In 1980, the price was $800. It peaked out, huh? But here I have $600. Um, uh, is this average of the year or end of the year? I have to check. It is not the absolute peak, but about 600. That's about $4,000 inflation adjusted. And then what's very interesting is to see what actually happened during the when gold was fixed in price. Um, well, what happened actually was that in the gold used to be very, very valuable, much more valuable than it was today, and the world was running on gold, still in the early 1900s, and all central. That's when central banks were created in 1913 or so, and that's when gold started to go down a lot in value when the price got fixed, when many central banks start to basically print money without backing it up with gold. But at the same time, the gold price would not go up because the central banks had a lot of gold, and so they were also selling off that gold, and thereby keeping the demand, the rising demand in check by loading off their own gold, and so not seeing too much pressure, upwards pressure for the price of gold. But this costs basically the value of gold go down from 40,000 inflation adjusted per ounce to only 400. It's like a total collapse in the value of gold is what we saw towards the end of 1960s. And then it was untenable because they had sold all their gold, and they had only a little bit left, and they didn't want to sell it also for stupid prices of $20 an ounce or so. So they closed the gold window, Nixon, and 60s, and then suddenly you couldn't get cheap gold anymore from the central banks, and the price started floating freely, and it jumped up in price from inflation adjusted $400 to 4,000 times 10. But now we're in a normal gold market. This is history. Now we're in a normal gold market, and a normal gold market means it's a commodity. It's money, but less and less over time. Less and less money. People use gold as money, so it goes down. That it loses value there, but also in general, commodities go down in value also. It becomes more and more a commodity. It's less money, more and more a commodity. The same like silver today is not money anymore. For the most part, it's a commodity. I don't know the percentages, but the majority of silver is not used as bullion or as coins, but is used in industries for its properties. That it's a great reflector, what the best reflector of light, the best transfer of heat and electricity, and therefore it's used often in applications. Silver, and that's But that's a commodity, and commodities go down over price because humans always become better in mining commodities at a cheaper price, and therefore they can sell it at a cheaper price also. So that's where we are with gold, and more and more. And so what you will see is that the adjusted for inflation, the price of gold will go down over time. Uh, of course, you have booms and busts, but that's the very long term trend. And so now we're at $2,000. Is that cheap? Well, since prices are floating freely, this is actually an average price. It's not cheap and it's not expensive. It's not $3,000 like 10 years ago or $4,000 like 30 years ago, but 40 years ago. But it's also not only $1,000 like 20 years ago. And what can we expect? We can expect to make in the next bear market a new low. The the highs will go less high over time, and the lows will go lower over time. And so the target is here not $1,000. The target for the next bear market is that we go to $800 or maybe $500. That's the new low, likely at the end of this bear market. So it's $2,000 expensive. Well, it's the average price of the past decades. That's true. So versus that, it's not expensive, just average. But considering in what cycle we are in a bear market of gold, actually it is expensive because because it will likely go to $800 and it's now 2000, and that will be take another 10 years likely. So it's a terrible investment today. If you invest $2,000 and you in 10 years you have $800 or $500 left, that's an absolute destruction of your capital. That's not losing half, it's losing 80% or so. It's very bad. And 10 years you wasted your time on that to get such a terrible return. So it's a terrible invest. That means it is a great short. Despite that we're not at all-time highs, it is a great short. And that's my conclusion. And that's why I continue to take in my positions, been building up my silver. Also, silver is the same story, just a little bit more volatile. But yeah, and we'll continue to do so. Try to get a bigger short position of in total not 7% short, but 25% short is my target. Why? Because that's what Kelly recommends. If I put in the numbers, um, shorting gold, upwards potential, you can make about 70%, let's say. Downwards potential, of course, can always go higher. But what's the absolute, realistically, what's the top possible here? It can go higher, 25%. That would be, we go to 2,500. That's possible. Let's say we're in a new bull market. Okay, we set a higher, but we're not going to reach likely 3,000 or 4,000. Likely the new high will be 2,500. So that's the upwards potential. We can go to 2,500. So I can lose 25% on this position. Taking it around current price of 2,000, I can lose 25%. What's the chance? Downwards potential, lose 25%. But what's the chance for that? That's not a high chance since the fear levels have been peaked already for the corona crisis. Actually, it's not 25%. Let's 20%. 20% chance I lose 25%, 80% chance I make 70%. What does Kelly recommend? Well, the expected outcome is 50%. Kelly recommends 70. You take half. Kelly recommends 30%. Let's raise this to 30%. That's the short position I'd like to take. And that's I'm not even counting the money I'll be able to make by getting when you short, you sell, you borrow those shares, GLD shares or SLV shares, you sell them in the market, and you are owed a debt, like you have to pay that back, these shares in the future sometimes, but you do get the sale proceeds, you get the US dollars from that sale, and you can invest in something else. That's not included in this calculation, but my average returns are very good. I probably will make extra profits on that, even able to basically invest it in something else and have even higher returns. So I think it's a great short. Um, Even if you keep just the US dollars on the account and you don't invest it, which is the case actually with some brokers, they don't allow you to invest the proceeds of a short sale. But interactive brokers does, I think. Of course, you have to meet your margin requirements, but I do believe you are free to invest that, and that's also all extra. That's not even included in the Kelly calculation here. So yeah, that's the story. I hope you enjoyed it, and have a great day.